Because Brent crude has climbed 40% since the U.S.-Israeli strikes on Iran began in late February, the Federal Reserve's path to rate cuts has effectively closed, and on Thursday, markets finally priced that reality in. The OECD revised U.S. headline inflation up to 4.2% for 2026, a full 1.2 percentage points above its December forecast, with the driver unmistakable: oil roughly 40% above where the OECD assumed when it last ran its models. The S&P 500 fell more than 1.5%, the Nasdaq dropped 2.1% into correction territory, and the Dow shed over 400 points, not because traders suddenly doubted corporate earnings, but because the oil shock rewrote the inflation arithmetic that the Fed needs to act. The OECD's baseline now assumes the Fed holds rates unchanged through all of 2026 and into 2027, a two-year pause while core inflation stays above 2%. Prediction markets assign a 97.7% probability that U.S. inflation exceeds 3% this year, and a 22.5% chance of a rate hike, a scenario that was unthinkable a month ago. The one condition that breaks this logic is a rapid Strait of Hormuz resolution. Goldman Sachs models Brent retreating to $80 in Q4 if flows normalize within 6 weeks, which would pull inflation projections back and reopen the Fed's hand. Until then, the market is pricing a central bank that has lost its ability to respond. The oil shock's damage to the labor market is arriving through a specific channel that Goldman Sachs laid out on Thursday. When energy prices surge, consumers cut discretionary spending first, and that spending collapse hits the service economy before it reaches any other sector. Goldman estimates the shock will suppress payroll growth by roughly 10,000 jobs per month through year-end, with leisure and hospitality absorbing 5,000 of those losses monthly, and retail trade shedding another 2,000. The mechanism is direct. Gas prices up approximately 26% year-over-year as of late March means less money for restaurants, hotels, and shopping, industries that employ the workers with the least insulation from energy inflation. Gen Z faces the sharpest version of this squeeze. Bank of America data showed the generation had only just surpassed baby boomers in year-over-year spending growth by mid-2025, fueled by slowing rent and 9% wage gains. That recovery is now at risk. Gen Z carries the highest ratio of gasoline spending to discretionary income of any generation and works disproportionately in the exact jobs Goldman projects will see the steepest cuts. Goldman notes that U.S. sensitivity to oil shocks is roughly one-third of what it was in the 1975-1999 period, thanks to lower oil intensity in GDP and domestic shale production. But even a muted shock hitting a labor market that already shed 92,000 jobs in February changes the trajectory. The unemployment rate is expected to rise to 4.6% by end of Q3, and the Fed cannot cut in response without reigniting inflation. If the conflict deepens and Brent spikes towards Goldman's $140 adverse scenario, the job loss estimate scales proportionally. The same mechanism driving oil higher, bond markets repricing for sustained inflation, is dismantling what was supposed to be the housing market's recovery year. The 30-year fixed mortgage rate climbed to 6.38% this week, the fourth consecutive weekly rise and the largest single-week jump since April 2025, when Trump's initial tariff announcement rattled bonds. 1 month ago, rates had slipped below 6% for the first time in more than 3 years, a threshold economists identified as the level that could finally draw buyers and sellers back into a market stuck at 30-year transaction lows. The mechanism connecting Iran to mortgages runs through the 10-year Treasury yield, which climbed to 4.39%, its highest since July, as bond traders priced persistent energy-driven inflation. For a buyer putting 20% down on a $450,000 home, locking in today's rate versus last month's rate costs an extra $1,120 per year, or more than $33,000 over the life of the loan, and mortgage applications fell 10.5% week over week as a result. The counterpoint is that sellers are still outpacing buyers by the widest margin in at least a decade, 630,000 more sellers than buyers per Redfin, which preserves negotiating power even at higher rates. If Middle East tensions ease and the 10-year yield retreats below 4.2%, mortgage rates could follow back towards 6%, potentially salvaging the spring selling season. If oil remains elevated and the 10-year holds above 4.4%, the spring window closes before it opens.
A Los Angeles jury finding Meta and YouTube negligent in a social media addiction trial triggered a stock reaction far larger than the $4.2 million in damages would suggest, because the case itself is the threat, not the penalty. Meta fell more than 8% on Thursday and is now down 18% year-to-date, trading near $546, against an analyst consensus price target of $853. The mechanism is a legal liability repricing. The LA case was explicitly structured as a bellwether for how juries view personal injury claims against platform companies, and Meta acknowledged in its Q4 earnings release that youth-related litigation could ultimately result in a material loss. A jury deciding that Meta knowingly engineered addictive products creates a template for thousands of pending cases across jurisdictions. The jury assigned 70% responsibility to Meta and 30% to Alphabet's YouTube, with both companies indicating they will appeal, but appeal timelines span years while legal exposure compounds. Snap fell 12% separately after the EU opened an investigation into Snapchat for allegedly failing to prevent child grooming, signaling that regulatory pressure is converging with civil liability simultaneously. Meta's RSI has fallen to levels that have historically preceded sharp relief rallies, and the 55% gap between current price and consensus target suggests analysts still view this as a temporarily broken stock. The condition that changes that assessment, if appeals fail and damages scale with plaintiff volume, the financial exposure stops being theoretical. A different mechanism broke the semiconductor trade on Thursday, not demand concerns but an efficiency breakthrough. Google revealed a new AI model architecture it claims can run large language models with significantly less memory, and the market immediately repriced the stocks most exposed to that assumption. Micron fell more than 4%, Sandisk dropped 7%, and Western Digital and Seagate each declined more than 4%, because memory demand for AI inference has been a core growth pillar for those companies. The logic of the sell-off is mechanical. If Google's approach holds and spreads, the memory intensity per AI workload declines, compressing the volume growth that memory makers were counting on. Nvidia fell 3% separately, caught between GTC conference optimism and a revived class action lawsuit over historical crypto mining revenue disclosures. But the more interesting divergence was between GPU makers and custom chip designers. Broadcom, which produces application-specific accelerators that hyperscalers use for inference rather than training, is positioned differently. Its AI chip revenue is projected to grow from $20 billion in fiscal 2025 to $60 to $90 billion by fiscal 2027, with hyperscalers buying Broadcom custom ASICs precisely to reduce dependence on general-purpose GPU memory overhead. If Google's memory efficiency claim proves durable across model architectures, the split between commodity memory and custom inference silicon may become structural rather than a single day's rotation. 3 mechanisms developed on Thursday that will determine how the next 2 weeks trade. First, the Iran ceasefire signal. Trump told reporters he doesn't know if a deal is possible, directly contradicting earlier White House guidance of a 4 to 6 week conflict timeline, and Goldman's Brent trajectory of $115 in April before retreating to $80 is built entirely on Hormuz flows normalizing within that window. Every day of ambiguity extends the oil premium and delays the moment the Fed's options reopen. Second, Carnival reports Q1 earnings next week as the first major travel company to disclose since oil prices surged. Its guidance on fuel cost absorption and forward demand will serve as a real-time test of whether leisure spending is holding or already breaking under the pressure Goldman's model predicts. Third, Meta's legal timeline. If early appeal filings challenge the negligence finding on First Amendment grounds, the stock's 55% gap to analyst targets may attract mean reversion buyers. If the legal structure proves durable across multiple jurisdictions simultaneously, the advertising revenue multiple compresses in a way analysts have not yet reflected in their models.